Hello friends, hope you're doing well. Chris Lee CPA here, back with another video for you. And today I'm going to talk about partner compensation in a partnership, or an LLC tax as a partnership. So I see sometimes some confusion about how and where we report uh, compensation of partners that are active in a partnership, and how that gets reported, and kind of how it all flows through for their individual tax consequences. So we're going to talk about this today. The first thing to start off is when we talk about partnerships, that applies to limited partnerships, limited liability partnerships, general partnerships, and LLCs that are taxed as partnerships. So the same rules apply for all of this. So if I say partnership, that's going to refer to an LLC. And in this context, if I say LLC, we'll just assume it's taxed as a partnership. But as we all know, LLCs can basically be anything. So when we think about compensation of partners and partnership taxation, we really are thinking, we first need to understand the primary mechanism, which is a guaranteed payment. So a guaranteed payment is sometimes falsely considered the a partner salary or that sort of thing. But it's important to know that for federal tax purposes, that partners are never employees of a partnership that they have ownership interest in. So a guaranteed payment by definition is a payment by a partnership to a partner that's determined without regard to the partnership's net income. Okay, so guaranteed payments are basically for services rendered by a partner to the partnership, or for use of the capital that is of the partner. So guaranteed payments are in exchange for services, or for the use of the capital of one of the partners. So because of that, it's important to just understand that it's not a salary. Okay, it looks more like 1099 income than it looks more like a salary, right? So that's kind of the most important thing to remember from that point. So guaranteed payments, because it looks like 1099 income, it is treated as ordinary income, and it is also treated as self-employment income. Self-employment income is ordinary income, but it has the unfortunate consequence of it having the 15.3% tax on top of it if it flows to a natural person's return, that is a Form 1040. At the partnership level, because it is compensation for services or use of capital, it is a deduction to the partnership. Okay, so if you've got $100,000 of income, $60,000 of guaranteed payments that get taxed to the partners, you've got $40,000 profit functionally. So because that's the case, it is reducing the income that is to be allocated out to the partners. So when we think of partnership tax, it is a flow through entity. So say we've got two partners of this partnership we've just created, and it's 60-40. We've got a $40,000 profit after we consider the $60,000 of guaranteed payments, and that $40,000 profit goes to partner A at 60%. So 40,000 at the 60% is going to be 24,000. And then we've got the 40% going to partner B at 16,000. So they're going to take their share of it and report it on their personal tax returns. And assuming they've got enough basis in the partnership, any distributions they take out of the partnership, right, their share of that 40,000 is non-taxable generally. Can be consequences where it is taxable, but we'll just assume that that's a non-issue for this purposes of this conversation. Now, at the partnership level, guaranteed payments again are deductible in determining ordinary income or loss, and the net income or loss is then allocated based on the partnership agreement to the partners, which generally is ownership percentage, but there can be reasons where we specially allocate profits and that sort of thing. So the allocable share gets reported on the K1 and ultimately reported on the tax returns of those receiving the K1. So that could be, an individual person, a natural person with their Form 1040. It can be a trust. It can be, an estate. It can be an S corp or a C corp, or even another partnership. It just flows out. Okay, so now that we've kind of got the idea of the primary mechanism for paying partners, that is through the mechanism of guaranteed payments, we want to talk about what it looks like if we want to pay someone with a preferred return. And the reason we would want to do this is because of the qualified business income deduction. So the One Big Beautiful Bill did expand, continue and somewhat expand the qualified business income deduction, in which case it does mean that we will see it continue and we can do some planning around it. So when we do that guaranteed payment function, because it is a deduction, when we use guaranteed payments to pay partners, because it is a deduction in arriving at ordinary income, it ends up reducing what is qualified business income, what is allowed, that 20% deduction. And it's important to know that guaranteed payments are, unlike 1099 income, usually, it is not treated as qualified business income. It is categorically not qualified business income. It's just, it's gets the tax consequences of 1099 income in the sense that it's self-employment income, but it is not treated as self-employment income from the purposes of qualified business income deduction. So guaranteed payments are specifically excluded under Section 199A. Now, as an alternative to that, what you can do is use a preferred return to compensate partners. And so there's no specific like tax law definition of what is a preferred return, but for purposes of this, we'll define a preferred return as a preferential allocation of partnership net profit. So to potentially a service partner, and then they get a preferred allocation, and then after that, the remaining profit will be allocated based on ownership percentage or some other arrangement per the operating agreement. So preferred returns really, can be thought of as a priority profit allocation. Or if you were in a corporate context and you've got preferred stock, like cumulative non-participating or cumulative participating stock or that sort of thing. The preferred stock gets paid first. Well, that's the idea here, is that the preferred return, that the service partner will get a preferred allocation, and then everything will go and flow to the bottom. Sometimes you might think of this as like a waterfall allocation, which isn't exactly what we would see here, but it's kind of an idea of that. So whether it's called a preferred return or some priority profit allocation or something like that, it's really just that the most important thing is to think about is that it's a specific allocation of net profit. It's not based on ownership percentage, and it comes before an allocation of partnership net profits based on percentage. So the payments usually are going to be treated as ordinary income, if that is kind of what the classification of that activity is on the tax return. That's most often what you would see. You can see it in some real estate deals and something of that nature, maybe in some hedge funds where it might have a different classification, but in our general context, we're going to think of it as ordinary income, and it's probably going to be subject to self-employment tax as well. But the big thing is that because the preferred allocation and the payout is through a distribution, the distribution is not a deduction to the partnership, and therefore it is not reducing the qualified business income. That ordinary income bucket is going to be treated as qualified business income. So that's what we're really thinking about here, is keeping qualified business income intact and as high as possible without having the service partner compensated for their efforts in the same rationale. So a lot of times what you can do is actually create a mechanism where the service partner really is getting the same amount of compensation but paying less tax. And really the biggest function of that is having an updated operating agreement that has some specific language in there. So the idea here is that an individual partner can potentially deduct 20% of their share of the partnership's qualified business income, subject to the limitations. And so again, guaranteed payments don't count as qualified business income. So when we're thinking of this, we really just need to think about the fact that we've got a pool of profit, without considering, partner compensation. We can go two buckets. One, it can be paid out to guaranteed payments and then the remaining to profit, or and the piece that does not get counted as guaranteed payments is automatically going to go to profit. Ordinary income to be distributed out. guaranteed payments, non-qualified business income, and then we've got the ordinary income, which is you know, subject to the 199A deduction, qualified business income deduction. And so if it's not guaranteed payments, it automatically goes in this other bucket. And to the extent that we can use this other bucket to do some special allocations by, you know, having a meaningful update to operating agreement that allows this, we can avoid having the unpreferred treatment that is the guaranteed payments consequence. So when we have the guaranteed payments, it's doing two things. That income is not subject to the qualified business income deduction, and then it's reducing the available qualified business income on the whole. So when we use the preferred return method for compensating a service partner, as long as the preferred return is not, you know, treated as disguised payment for services rendered to the partnership, you will get the qualified business income treatments. What this really does is it maximizes QBI deductions for really the service partner and other partners. And so we would want to consider replacing guaranteed payments that don't count as qualified business income with preferred return payments that do count as qualified business income. So that's really the strategy here, and it takes a little bit of you know, nuance and work to practice. So really, if you and other partners are going to decide to go down this route, you really do need, like, you know, someone experienced in partnership tax to kind of work with and talk about what this might look like for you. There are all sorts of arrangements and how you can do this. But it really does take, you know, an attorney that's familiar with operating agreements for partnerships, and, you know, potentially someone very familiar with partnership tax, you know, a tax attorney, a CPA, maybe an enrolled agent that has good experience with partnerships. And you're going to probably need to amend your partnership agreement to make this change. So rather than talking about compensation through guaranteed payments, talk about compensation maybe with a mix of the two. So it's not even that you just do one or the other. You might do a mix of both. And what that really does is it helps avoid those disguised payment for services, right? That's really the biggest risk is, so if we're doing a split of both and managing the consequences, it does reduce our risk if the arrangement was ever audited. So when it comes to this, you might need to amend your partnership agreement. And so the general rule is that for amending a partnership agreement to be effective for federal income tax purposes, as of the first day of the partnership's tax year, the amendment must be made no later than the due date of the partnership's tax return for that year. So that's to say, if you want, say, like a 2026 tax return to have this sort of arrangement in it, you're going to need to have your partnership operating agreement updated by the you know, March 15th, 2027 deadline. So you may have to work through that. So just something to say. So if you're thinking of trying to figure out how to maximize your QBI benefits and you're in a partnership structure, QBI being qualified business income deductions, this might be something to consider. And certainly feel free to, you know, this is where, you know, it makes sense to have a direct consult to understand all the economics of all the partners and everything that's going on. And so if that's of interest to you, feel free to book a call using the link in the video description. And I hope to, hopefully we'll be back with you soon with another video talking about some tips and tricks, and we can go from there. So, all right, it's my pleasure. Take care. Bye-bye.